Hi, it's Kevin Jordan here with another episode of the Small Business Marketing Minute Show. It's the show that gives small business owners like you simple, affordable, and above all, practical tips for growing your business and teaches you the famous duct tape marketing system. One of the key concepts taught by duct tape marketing is to use the lead generation trio of advertising, public relations, and referrals to get new customers for your business. One important factor in the success of your public relations efforts is issuing well-written and properly formatted press releases about your business. So today, I'm going to teach you how to write a press release. However, before we talk about how to write a press release, I'll quickly go over why you might want to issue a press release, because it's something a lot of businesses aren't doing, and I think part of the reason for that might be because business owners just don't think that there's anything newsworthy about their business. I can assure you that this couldn't be further from the truth. If you are in business, there are any number of things about your business that might be newsworthy. For example, every time you hire a new employee in a key position or introduce a new product or service, that's a great time to issue a press release. If your business is sponsoring an event or hosting an event or contributing to a charity or doing anything at all to impact the community in a positive way, those are all great reasons to issue a press release. For example, when I started the podcast you're watching right now, I issued a press release about it that was picked up and posted on over 170 websites. And when I taught a free workshop from my local Chamber of Commerce, I issued a press release about that, which was printed word for word in my town's newspaper. Now that you have an idea of what you might want to issue a press release about, let's talk about how to actually write it. Because the fact is that if your release isn't properly formatted, then nobody will pick it up or print it. The first and most important part of your press release is the headline. Your headline needs to get a reader's attention and make them want to learn more. And if you're distributing the press release online, it should also contain some keywords that people might be searching for. For example, the headline I used for my press release regarding my workshop was Farmville Chamber of Commerce to sponsor free small business marketing workshop. The next part of the press release is the summary. This should be 1 to 4 sentences long and provide a brief description of your business and the subject of the press release. Sometimes when your online press release is picked up, the only parts that will be displayed are the headline, summary, and a link that people can click to learn more. So it's critical that you get in the most important information here. After the summary comes the dateline and lead paragraph. This is basically the who, what, when, where, why, and how information. It should be about 25 words or less, and you shouldn't assume that the person reading that has already read the summary, because that summary may not always be included. The body of the press release follows the lead paragraph. This is where you tell your story, but you need to write it in a neutral tone using the third person, as if you were a reporter writing about your business. Include quotes from key people, statistics, and other details that support your story. At the end of your story, you should include a boilerplate statement that you can use at the bottom of all your press releases, which just gives some general information about your company. It should just be 1 or 2 sentences long and include a description of your products or services. Last but not least, you should include your contact info in your press release, including your name, email, phone number, and website. It would be a shame if a reporter saw your story and wanted to write an article about it, but couldn't reach you for comment. Now, I realize that I just threw a lot of information at you, and you're not going to be able to sit down and knock out a press release based on simply listening to me for a few minutes. However, if you go to the URL you see on your screen, you can download a guide to writing great press releases and also see some examples of press releases I've written for my business. On the other hand, if you're thinking that there is no way you're going to take the time to learn how to write a good press release for your business, then tune in for tomorrow's episode of the show when I'll have on a special guest from a new service that writes and distributes press releases for your business. If you haven't already, make sure to subscribe to the show on iTunes so you'll get that episode as soon as it's published. If you have an example of a press release that you've written for your business, I'd like to share it with the viewers of this show so that they get a better idea of how to use press releases for their business. Send your release to podcast@redpointmarketingconsultants.com or go to redpointmarketingconsultants.com/marketingminute and put a link to your release in the contact form on that page. If I mention your release on a future episode of the show, I'll send you a free copy of the book Duct Tape Marketing. That's all I've got for today's episode. Thanks for watching, and I'll see you tomorrow. Hey, it's Kevin again with 3 quick favors to ask you before you go. First, if you find the information I share on the show helpful, please share a link to the show's page on iTunes using your favorite social media platform. Second, if you enjoy the show, please let me know by leaving a 5-star rating or writing a review on iTunes. Third, send me questions you'd like me to answer on the show by visiting redpointmarketingconsultants.com/marketingminute and filling out the form to submit your questions, or simply send an email to podcast@redpointmarketingconsultants.com. Thanks for your help, and I'll see you next time.
The GXP1610 from Grandstream is an easy-to-use IP phone that is perfect for small to medium-sized businesses, office buildings, home users, and hospitality settings. The phone supports a single SIP account and up to 2 call appearances, which makes it ideal for users looking for a simple and easy-to-use IP phone. The GXP1610 features a full duplex speakerphone and electronic hook switch support for Plantronics headsets, allowing users to simply press a button on their EHS-compatible Plantronics headset to answer or hang up calls on the GXP1610. A 132 by 48 display allows users to easily browse through contacts, missed calls, voicemails, and more. To make it easy to keep in touch with business and personal contacts, the GXP1610 features a built-in phone book with room for up to 500 contacts. Those who need to keep in touch with clients and employees will also enjoy the 3-way voice conferencing feature of the GXP1610. In terms of security, this phone features the most comprehensive security encryption available on the VoIP marketplace today. Provisioning the GXP1610 could not be easier, as it supports all major provisioning methods. When paired with Grandstream's UCM series of IP PBXs, the GXP1610 can be set up using the Zero Configuration feature on any UCM IP PBX for quick and easy setup. The UCM series can also offer the GXP1610 an extra set of features, including one-touch call recording, provisioning from the phone, and more. Those looking for an easy-to-use IP phone with comprehensive security protection should look no further than the GXP1610 from Grandstream.
If you're on this call, chances are it's because you are a trusted advisor to small businesses, that you have clients that are small businesses that are struggling through today's tough credit environment. And as a trusted advisor, it behooves you to become accustomed or familiar with the different forms of financing out there to help your clients. And what I hope to do today is to make you a little more familiar with one of those types of alternative types of financing. That is factoring. And I can tell you on this call today, we have bankers and CPAs, attorneys, business coaches, consultants, a variety of professionals, all trying to help small businesses in today's tough economic environment. And today I'm going to give you a basic understanding of factoring, how it works, the relevant terminology of factoring. I'm going to go to in sort of a step-by-step explanation of how factoring works at Versant, give you a feel for the competitive landscape, learn more about who else is out there providing factoring, the differences among different types of factoring sources, and when you might choose one over another. I'll go through some questions that I expect many of you will have after the presentation, and then some examples of some recently funded transactions. But as I said here at the beginning of the presentation, the GoToWebinar tool provides you a mechanism to submit questions during the course of the presentation. You can do that through chat or through the questions feature, but those will come to me, and then I'll go through all of them at the end of the call. And if for some reason we don't have time to get through them on this call, I'll contact you personally to answer those questions. Now let's dig a little bit deeper into the presentation. Just to start, what is factoring? In its simplest terms, what factoring is a sale of a company's accounts receivable in order to obtain working capital. There's lots of types of factoring out there. What Versant provides is called non-recourse full notification factoring. What that means is the account debtors, which is another term for the customers of our clients, they are notified to pay Versant directly rather than paying their supplier, and we take on the credit risk. We take on the risk of non-payment from that customer. So your client is getting a form of credit insurance by factoring their receivables. My background is SBA lending, so I'm very familiar with the terminology of lending. The last bunch of years I've been doing factoring, and I find this is a good translation because I know many people on this call might be more familiar with loans than with factoring. So sort of the comparable term to loan in the factoring world is a factoring facility. We don't talk about loan amounts because we're not making loans, we're buying assets, particularly the receivable. We talk about factoring volume. There's no lender. We have a factor or the purchaser of receivables. That's Versant funding in this case. Instead of a borrower, we have a client or the seller of receivables, which is usually your client that's coming to us for funding. There's instead of a note or loan agreement, we have a purchase and sale agreement, making it very clear that what we're doing is we're buying assets from our clients, we're buying accounts receivable from them. There's no interest rate, and that's a telltale sign that somebody talking about factoring maybe doesn't have a good handle on how it works. They start asking about interest rate. There's no interest rate because there's no loan. There's a I'm sorry, I might have just lost audio there for a moment. But again, you've seen this chart, and I think you've got a good feel for how the two different terminologies compare. Our client profile, we are looking to fund small to medium-sized companies with revenue anywhere from $1 million to $100 million. We've got a few that are a little smaller. We've got several that are quite a bit larger than that, but that's our target. Our average client probably has about 5 to 10 million in annual revenue. And what they all have in common is that these businesses crave liquidity. They need cash. They just can't wait the 30, 60, 90 days to get paid by their customers. And what we do is we provide them that quick cash. The day they issue an invoice, the day they complete a sale, we're providing them valuable cash against those receivables. If a client is coming to us for factoring, chances are they've been aced out of the traditional funding markets, and that can be for any number of reasons. It could be that it's a brand new company, doesn't have a track record yet, doesn't have a history that banks like to see before they lend to a company. Maybe they're just growing rapidly. That steep growth curve can spook a lot of banks. They're just not interested in working with a company that's growing too fast. Or maybe revenues are erratic. It's a seasonal business and revenues and profits go up and down. A lot of our clients, the reason they're not bankable is because they're in some form of distress. Revenues might be trending down. They might be experiencing losses. Maybe they're in the process of going through some major restructuring. It's not uncommon for our clients to currently be in workout with a bank. All of those things are okay. For whatever reason the client is unbankable, provided they've got good quality receivables, there's a great chance that we can help them. What's important to us is that our clients' customers be strong, and they are typically large corporations. Often they're municipalities or other government agencies. But just also to clarify that it's very easy for us to factor receivables due from household names with AAA rated credit. Those are easy. But there's plenty of companies out there that the credit is good enough for us to factor their receivables. So for example, if we've got a client and they're selling millions of dollars to Walmart every month, that's easy. We'll buy it all. But if you have a client that's selling maybe tens of thousands of dollars to a medium-sized company, that could be okay too. Now, we probably wouldn't factor millions from that medium-sized company, but it's all about the credit strength of the company being commensurate with our exposure to them. So there's lots and lots of companies out there whose receivables we would be very happy to factor. For us, we work with a wide variety of industries. So it's easier for us to tell you the few industries we don't work with, and those are medical and construction. But just about any other industry is fair game. And when I say medical, we won't factor receivables due to medical practices from insurance companies, Medicare, Medicaid, those type of receivables. We happily factor medical billing companies, medical equipment suppliers, medical staffing. It's just that those particular brand of receivables insurance company, Medicare, Medicaid, we avoid. But that leaves a wide range of industries that we can factor. So in our portfolio, we have manufacturers, we have distributors, wholesalers, staffing. It really is a wide range. What they all have in common is good quality receivables. How we help is we provide our clients quick liquidity. We get them cash very rapidly. And it's not uncommon for us to go from you're introducing us to a client to 5 days later we're funding them. The reason we can move so quickly is we are not underwriting your client's business. We're looking at their receivables. Who are their customers? So with as little as a recent account receivable aging and a customer list, I can tell you within 24 hours whether or not it's a transaction that we can accommodate. Now, the biggest hurdle to us funding a transaction quickly is if there's an existing lien on the receivables, if there's existing financing in place. That doesn't mean that we necessarily can't help the client. It means we've got another step we have to go through. We have to get the cooperation of that existing lender. That might mean we have to pay them off in full, which that's the simplest way of going about it if the cash is there to do it. Or we have to get them to agree to subordinate or release their lien on those receivables. And we can sometimes do that through a partial pay down with ongoing scheduled payments thereafter, or some combination of pay down, release of collateral. But we've got a lot of experience in helping our clients work with their existing lender to try to get them to cooperate and release that lien so we can provide the client the liquidity they need, hopefully, to grow themselves out of a bank's workout department. In terms of how a business uses factoring funds, again, comparing it to my time as an SBA lender where we had to account for where every penny of loan proceeds was spent, with factoring it's completely up to the client how they want to use the proceeds. But what I have here is a list of common ways our clients use factoring proceeds. Sometimes to finance a project. It's very often to fund growth or take advantage of a supplier discount. We have some clients that are in bankruptcy and we provide debtor in possession financing. We've helped clients to acquire a business by turning the receivable portion of the purchase price into cash to help meet the buyer's price. But generally it's used to meet the ongoing working capital needs of the business, and it is used as a bridge, as a short-term gap that we help to fill. And what we like to think is we're bridging our clients to bankability, to where they are now, whether it be new, in distress, or rapidly growing, to a stabilized point where a bank is more interested in lending to them. Now I'm going to try to give you ideas to the flow of cash in a factoring transaction. Usually our client completes a sale. They either provide their service or deliver the product and invoice their customer. Usually that same day we receive the invoice and we verify it. We contact their customer and confirm that the invoice they provided us matches with what the customer received or was provided. Then we wire our client 75% of that invoice amount immediately. And now we get paid directly by the client's customer. When we receive payment, maybe it's 30 days, maybe it's 45, maybe it's 60 days later, we then forward our client what's called the rebate. That's the balance, that remaining 25% we didn't initially advance, and then take out our factoring fee. And on an average transaction, our factoring fee is anywhere from 2.5% to 3% of the invoice amount for every 30 days that invoice was outstanding. A little more specifically, it's 2.5% on average, 2.5% for the first 30 days, then 0.84% for each additional 10 days. So the longer that invoice outstanding, the higher the fee will get. But we give our clients a lot of information, a lot of data on the performance of their receivables. So they'll know what's outstanding, how long it's been outstanding, so they get a feel for what that fee is going to be, and they've got some ability to control that. They can buy back a receivable. Let's say they've invoiced a customer, we factor that invoice, and now there's a dispute that they're working through. The client might want to buy back that invoice to avoid that fee accruing and getting higher and higher on that invoice that's in dispute. But what a lot of our clients tell us is when they initially come to us, they worry, well, if I start factoring my receivables, I'm going to start to lose control. I'm not going to know what's going on with them. I'm going to lose my connection to my receivable. But once they're with us for a while, they realize, well, they actually have more information now than they did before they factored. The information we provide in the form of this online system, the service in terms of our being much more on top of their receivables than they usually are, usually provides improved performance and increased information on how their receivables are doing. And then receivables it's a constant flow of cash between Versant and our client. That's what I try to illustrate here in this diagram, is that some clients, as often as every day, they're providing us new invoices. We're issuing new advances of 75%. We're getting paid by their customers, so we're giving our clients that rebate. Usually every week we provide a rebate to them. So it's a constant flow of cash. And one of the advantages of factoring over a asset-based line of credit or a more traditional bank facility term loan is that the more the client needs, the more they can use us. The greater their sales, the more we'll factor, as long as they keep selling to good quality company. So as the business grows, this facility just grows automatically with them. It's not like, okay, 6 months from now the revenues have doubled and they need to ask for an increase, an extension. No, as long as they keep selling to good quality companies, we just grow right along with them. And that's our hope, is to help them grow to a point where they can pay us off with a bank facility. Next, I'd like to give you a little feel for what else is out there in the factoring universe. There's a couple of main categories of factors out there. Largest category, we call category 1 here, is lots and lots of little factors. These are typically companies that are not very well capitalized. They might have a small bank line of credit. They might have some owner capital in the business. But they've got a lot of restrictions on the size of the deals they can do, the industry concentration, the customer concentration that they allow, and they're really looking for companies that have a low need, a small need for funding on a monthly basis. And there's lots of them out there. Then there's next category of factor, which are some of the big boys, CIT, Bibby, Rosenthal. They are large companies looking for well-established companies, usually just one small notch below what a traditional bank would be willing to fund. And I can tell you both of these categories of factors are referral sources of mine. Because we don't overlap very much, we're looking at for different types of deals. Where Versant might be a little different is our willingness to do large deals. For example, a lot of the other factoring companies have restrictions on how much they can fund any one company or how much concentration they can allow the company to have with any one customer. We are privately owned and privately funded, so it's up to us to figure out the kind of deals we want to do. So we tend to do some larger deals. We've got clients that are factoring as much as $15 million every month with us. We've got clients where they are only factoring a single customer. So in other words, 100% customer concentrations, which just you can't get that from any other factoring companies. Also, since we are a small privately owned company, we are more of a boutique and provide the kind of service you might get from a small investment bank or a small private bank. We've assigned each of our clients an account executive, which is similar to sort of the private bankers of old. So just one example, our typical deal has a 75% advance rate, as I mentioned earlier. Maybe a business has a chance to take advantage of some great supplier discount or has an immediate need for a little more cash than usual. They contact their account executive and ask for an increase or an over advance, which we do all the time, which we then pay down over time. But the point is they have not just an 800 number where they're stuck into customer service nightmare of hoping somebody answers their call. They have a person they talk to who knows about their business, who knows what they're up to, in addition to all the automated tools we provide to provide data in the form of web-based reporting on the performance of their receivables. Next, I just want to go through a few questions I expect many of you may already have about Versant. Basic requirements for factoring. Well, that a business sells something, whether it be a good or a service, to good quality customers. We can do business in all 50 states. We've got clients all over the place. We just want to see that a company is based in the U.S. and sells to U.S. companies. We've made a few exceptions where we have funded some businesses that are based abroad or selling to foreign companies, but that's not our specialty. Our specialty is working with U.S. companies who sell to U.S. companies. Does Versant require certified financial statements in the application process? Answer, no. We don't need to see financials. We don't need to see tax returns or personal credit or personal financial information. For us, it's all about the receivables. It's all about the customers. So we're not going to look at that information. What's important to us is who are the customers. The next question is, does a company have to be profitable to qualify for factoring? And again, the answer is no. Some of our clients are brand new. They don't have a track record yet. They're not yet profitable. But with our funding, hopefully we can help them get there at some point. And a lot of our clients, they were profitable and hope to be again, but they've got some problem. Sometimes the problem is mismanagement through the recession. Sometimes the problem is the industry has changed very quickly out from under them, and they're working to line things up again. In many cases, just the recession just changed the game on a lot of these companies, and they're working to get themselves back in shape. But right now, they're not profitable, and that's okay with us as long as they've got those good quality receivables that we can factor. Next question is, how long does the closing process take? Well, as I referenced earlier, speed is what we're all about, and it's not uncommon for us to go from introduction to funding a week later. Again, the most common delay will be, honestly, often it's the client just being slow to sign documents and getting them back to us, or the other is that existing bank lien that I mentioned. If it's out there, we've got another hurdle we need to get over with some, hopefully, a little persistence and some cooperation, we can get there, but that's the most common reason a deal is delayed is a lien. From companies in which industries will Versant purchase accounts receivable? Well, as I referenced earlier, most industries are eligible. We stay away from medical practices and construction, and I know some specialists in those industries, so if anybody on this call is looking for that type of connection, I'd be happy to put you in touch with someone, but we do everything else. We've got manufacturers, distributors, wholesalers, staffing, consulting, software. Again, as long as they've got good quality companies, we're not too concerned about what they sell. Is there a minimum volume of receivables which a client must commit to factor in order to qualify? In most cases, we look for companies that can factor at least $100,000 per month. We've been known to do some a little smaller if we think there's an opportunity for that business to grow and go beyond $100,000. But we're not in the business of doing real small deals. And again, I've got people I could connect you with if anybody in this call is looking for someone there. Next question, does Versant require personal guarantees? The answer is no. It's one of the great advantages of our program is that we do not require personal guarantees. The reason is we're not looking for the owners of the company for repayment. We are looking for their customers to make payments. So as long as we're comfortable in the credit of their customers, we're not looking for personal guarantees. And I mentioned earlier that other factors are a great referral source for me, and that's often one reason is that the owners cannot or will not provide a personal guarantee, which just makes them ineligible for factoring in most places. What we do require is called a performance guarantee, and sometimes that's referred to as an anti-fraud guarantee. And what that's about is someone at the company, our client's business, must stand behind the quality of the work or product. And what that means is, let's say we factor or purchase a receivable and the company doesn't pay. Well, if they don't pay because they can't, they're out of business, that's our loss. If they don't pay because they refuse, because the product was defective or the service provider was not what they requested, that's still our client's responsibility. So that's the performance guarantee. They guarantee that they've performed the service, provided the product that was provided for in those invoices. Who qualifies for factoring? Well, we've got a wide range of companies that qualify, including those that are in distress, so negative net worth, losing money. We do provide what's called debtor in possession financing, DIP financing, for companies that are currently in bankruptcy. And we do see sometimes that a company might be currently with a bank, but the bank is willing to release some collateral in order to give the client a little extra working capital to hopefully get them out from their problems, and we can work with those all the time. It's common for us to work with companies that are currently in workout with their bank. Next question, can a company with little or no credit history qualify for factoring? And yes, we have had clients where we factored the first invoice they ever issued, so brand new startup, no history at all. And honestly, we had a couple clients where what little history there was not positive. The owners had a history of a couple of failed businesses in the past, so they were really unbankable. But what they had going for them was some good companies, some good customers, some good receivables. So what we hope to do is help them reestablish a track record so to the point where they can reprove themselves and qualify for bank financing down the road. Must the client's customers always know when a company is seeking financing through factoring? The answer is yes. The reason we're able to get our clients money so quickly with so little review of their financial condition is because we're relying so strongly on their receivables and getting paid by their customers. So it's important to us that those customers pay us directly. Now, as this next question poses, will a company seeking factoring be viewed negatively by its customers? And while all of our clients are worried about this, And it's wise to do that. You should worry what your customers think of you. It's not the negative, it's not the red flag that many of our clients expect it to be, particularly if our clients are selling to good quality big companies. Those big companies, they are paying factors already. They've got hundreds, in many cases thousands of suppliers who are getting paid through a factor. And often it's nothing more than a switch being flipped in an AP system, and now checks are cut to a new location. Often our clients' main contacts at their customers aren't even aware of this change, so it's so routine. And also, we are still in a very tight credit environment, and while companies don't really brag about and talk about how they're getting funding to factoring, many are. And the fact that they're needing to tell their customers that they've got financing and it's through a factor is not a negative. It's often viewed positively in that now their customers know, okay, they've got the capital they need, they've got the funding they need to continue to service us as an account. So it's very common that our clients worry about this. In the end, it's not the issue they expect. And a common way we help to overcome this objection is once we've had a conversation, once we've reviewed the receivables, we figure out, okay, this is a viable deal that we think we can do, we let them talk to some of our existing clients, clients that came into us maybe a year or more ago with the same worries, the same concerns about what is this going to do to my customer relationships. And then by using us, they realized that it's just not an issue. It's not impacting their relationships in a negative way. So we let them hear it directly from our own clients. Came to us with the same concerns they had so that they can help put their mind at ease. This next is an illustration I like to show that gives people the idea of how factoring can actually improve profitability. Because we talked about how factoring is going to cost about 2.5% per month. So some people wonder, oh my God, that's outrageous. That's so much money. How can I afford to pay that much? Well, it's all about what you're comparing us to. And often our clients, if they could qualify for a cheap bank line of credit, they would do that, and they should if they can get all the funding they need from a bank. But if we can help them complete more sales than they could before using us, it can make a lot of sense. And here in this example, we show that, okay, revenues go from 100 to 200,000 by factoring. The cost of goods sold and the gross profit remain constant through factoring, as do their variable costs as a percentage of sales. But now add in the cost of factoring in the after factoring example. So in this case, the factoring was going to cost them $10,000 additionally. But because revenue were able to increase, in this case they were able to double, now that might be a bit extreme, but it shows that a profit went from 5,000 to 20,000. And this is certainly, these are very round numbers. This is not a perfect real life example, but it can show you that if revenues can go up, you can do incremental sales by factoring. Paying a factoring fee can make a lot of sense. And what we hope our clients can do by using us is grow, bring on new customers, increase sales, get stabilized, and then pay us off with cheaper financing down the road. Maintain those sales, and then you take out the cost of factoring, replace it with a smaller number in the cost of the bank financing, and net profit just goes up even that much more. But we'll provide that bridge to help them take on the new customers, increase sales, and eventually really increase their profitability. Next, I'd like to cite a few examples. I think these can be a great way to help visualize when a client would be a good referral to Versant. This first one is a consumer electronics manufacturer. This was a long-standing business. I think it was probably close to 20 years. And they sold sort of a lower-end tablets, e-readers, MP3 players, that sort of electronic. And they had some great customers, selling to mainstream retailers. But then they had a problem. They had a large shipment of a defective product go out to one of those retailers. But they did the right thing. They took it all back, refurbished it, and eventually resold it. But it cost them a lot of money to do that. In addition, it violated their bank covenant because of their high return rate. And the bank was not willing to renegotiate. They froze their line. So they needed financing as soon as they could, as soon as possible, to meet their working capital needs. And no other banks would consider it because of the size. This was a substantial transaction. Also, the industry spooked a lot of the other factors, because what factoring companies worry about in the world of electronics is they worry about a return, which happened here. So a defective product goes out and it comes back, and there are repercussions. But we were willing to jump in, and we were ready to fund in the time frame that they required. Next example is a commercial printer, sort of an old line business. They were still holding on while a lot of other printers are falling off, just going out of business. This one held on. Their little niche was they would print statements for cell phone customers. So while lots and lots of people are getting their cell phone bills electronically, there's still literally tens of millions who get a paper copy every month, and this company helped to print a lot of those. The issue here was this company was recently acquired. The buyer purchased it using a large portion of seller financing, and the seller was sort of getting her nose into this business, was contacting customers, contacting suppliers, was really being a nudge, and they had to get out from under her. So what they did was they did a sale leaseback of some of the printing equipment to raise some capital. They factored a big chunk of the receivables to raise some cash to pay her off and get her out of the business. So that one was a little bit unusual for us, but still in the end, this company couldn't get bank financing. They were able to get out from under their problems by factoring their receivables. The next example is a software provider, and this company did security software, and their issue was they were very focused on a merger. They put all of their resources for the better part of a year into making a merger happen, and the merger was with a complementary technology, and they expected that this was really going to take them to the next level. But in the meantime, they neglected the core operation of the business. Financials suffered, new product development suffered, customer relationships suffered, revenues started ticking down, 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 and then the merger didn't go through. They were no longer bankable. They had some slow-paying receivables due to some pretty good entities, some hospitals, from hospitals, from municipalities. So these were good quality customers, but they were paying slowly. Other factors shied away because of the nature of the industry being software. A lot of factors are uncomfortable with software. We were able to get there, and this company is actually been our client of ours for about a year now, and is looking much better than when they started with us. Next example is a t-shirt manufacturer, and this company had really struggled through the recession. Sales were way down, and this is another case of a little bit of mismanagement in that they were very close to bringing on a very big customer who was going to buy a whole lot of their product, and they started to grow inventory to meet that demand, but then the deal never went through. So they were now out of covenant on their bank loan. They had much too much inventory. Thankfully for them, it's fairly generic. Mostly blank T-shirts. They thought they could sell them eventually, but it was going to take some time, and the bank was not going to cooperate. They were not going to be patient through that process, so they froze their line. They needed an alternative source. They were able to get a large principal reduction from the bank because the bank really wanted to get rid of them, but this was a tough deal not only for a bank but for other factors because the financial condition of the business was really, really weak, and there was going to be a high customer concentration, but we were able to get there through an intercreditor agreement. We were talking about partnering with an inventory lender on this deal, and we were again going to be ready to meet their funding needs. So that's the bulk of my prepared presentation. As I said, I asked you to submit any questions you might have through the features of GoToWebinar. So let me just, if you can bear with me a moment as I check to see what questions we might have. First question is, will Versant fund international deals with foreign customers or foreign clients? Well, it is not our specialty. We really are focused on working with U.S. companies that are selling to other U.S. companies. We have made the occasional exception, but I don't want to give you the impression that we're focused on international business. Question here, I see, do you have programs? I'm sorry, what guarantees do you require? We don't require a personal guarantee. We require what's called a performance guarantee. So we need our clients to stand behind the quality of the work or the quality of the product delivered. But we do not require that they sign a personal guarantee. It's actually one great advantage of our product over some others is a lot of factors do require a full personal guarantee, but that is not something that we do require. Next, what information is required for underwriting? Well, we don't need a whole lot. What I can do is I can send anyone who'd like a copy of our intake checklist. It spells out the few pieces of information we need in order to assess a client for factoring. But what it comes down to is we want to know who are the customers, so a customer list, a recent receivable aging, tell me about the margins of the business. As we talked about in our example, if the margins of the business are strong, there's lots of room in there to increase profitability by increasing sales and still eating the cost of the factoring. So we want to know about the margins and what other liens might there be in place. So with a few questions, a few pieces of information, we can very quickly tell you if your client is viable. So I'll be happy to send anybody that checklist after the call. What if the company is service-oriented? We're happy to work with service businesses. We've got a lot of them. Staffing companies are a great example. If you've got a staffing company, you better pay your employees every 2 weeks or they're gone. But your customers are probably paying you in 30 days if you're lucky, maybe 45, 60 in most cases. So that's going to cause a gap. If you've got a deep pockets or a bank line of credit, you can easily fill that gap. But if you don't, you need help. And what we can do is when we factor those invoices, they're getting 75% of the cash the day they issue it to pay their employees, keep the place running, and then the balance when they get paid less our fee. So service business we're happy to work with. We're still verifying the invoices. Just instead of verifying delivery of a product, we're verifying completion of a service. Do you offer purchase order or PO financing? To a limited extent. We really are focused on factoring. Factoring is really what we do, but in some cases we can offer PO financing, and the way we do that is we issue a letter of credit that will be payable to a client supplier once the product is in the hands of the end customer. So this works in cases where there's a third-party manufacturer. So your client is quote-unquote manufacturing a product, but it's really being produced in China. And we put up a letter of credit that allows that Chinese manufacturer to produce it without getting paid up front. I often get calls from people looking for what they call PO financing, looking for me to give them cash now against a PO, and that's not available because just a lot can go wrong from the time you get a PO to the time you deliver a product. So that limited PO financing we offer is when there's a third-party manufacturer who will do work with an LC instead of cash. And then the way we pay off the LC is by factoring the resulting receivable when the product is in the hands of the end customer. So PO financing in those very limited cases, I'm happy to talk to anyone with greater interest after the call. Next question, do you consider in-transit inventory as part of the inventory collateral or only what's on hand? We don't fund against inventory. We are strictly a factoring company, so we factor receivables associated with delivered product or completed service. So we do not finance inventory. I often will work with inventory finance companies if inventory is a big part of a client's assets and they need that extra cash to meet their needs. So I'm happy to talk with you about connecting you with a source if necessary. Next, what are common reasons for a decline of a factoring transaction? Well, the biggest one is just the quality of their customers. For example, if a company is strong, maybe they're doing well, they've been around a long time, but their customers are small, independent businesses, that's just not a good fit for what we do, because for us it's all about the quality of their receivables, the quality of their customers. So that's not much we can do there. On the flip side, if a company is brand new or no history or a weak history, but they've got good quality AR, we can help them. So the quality of the receivable is the biggest reason for decline. And then the next, I'm not sure if you'd call this a decline, but it's the most common reason why we don't fund a deal, in many cases deals that we would like to fund, is an existing lien on the receivables. We talk to clients all the time that they've got a bank facility, but it's just not large enough. It just doesn't meet all of the working capital needs. But they've got a blanket lien on all assets, that bank, and that means we can't do anything for that client until that bank is paid off or that lien is released. So that's the most common reason why a deal doesn't go through, is because there's that existing bank lien that we just can't get out from under. Do you have programs for brokers? And absolutely, a lot of our business comes to us from brokers. We've got a referral program. We pay referral fees to brokers when appropriate. So I'm happy to talk to anybody who wants to learn more about our broker program. Because of the nature of our business, we do not market this business directly to customers. We market all to their advisors, and among them are brokers. So we're happy to work with brokers. Tell me a little bit about Versant, your ownership, your funding structure. Well, as I alluded to earlier in the call, we are a privately owned company. We are privately funded. Our owner is our funding source. His name is Mark Weinberg. Mark's got over 20 years in the factoring business. Was one of the co-founders of Platinum Funding years ago. Sold his interest Did so without signing a non-compete, so I was able to start up another factoring company, and I've been working with Mark for about 4.5 years now. And what I love about working with this company is, again, I mentioned I used to be with an SBA lender. I was actually with CIT most of my career. A lot of strengths to that company, but it's a large company with lots of layers, lots of bureaucracy. And here I have very quick access to the decision maker. Once I determine deal sounds viable, we'll quickly put together a call with the owner of the company, with Mark, and we talk about, is this a deal we want to do? If the answer is no, you'll know that very quickly, and maybe we'll have some ideas for you on where we can point you to another financing source. But if the answer is yes, you only have to hear yes once. It's not like you're going to now go to an underwriter and then to committee, and then it's just you're going to find out very quickly if the deal is viable, which is great for initial decisions. It's great for us doing some aggressive deals that others would not do. It's great when you're a client of ours and there's issues, and we get to talk to, not just some customer service drone. You're talking to the owner of the company. So it's a great advantage to work with Versant is our ownership structure, and we're also very well capitalized, which allows us to do some very large deals, some high concentration deals that are just not typically available out there. Well, I think I've answered all the questions that the audience had. I really appreciate your time today. Each of you will receive a link to a recording of this conference so that you can listen to it and forward it to anyone you think also might be interested. And I look forward to us having an opportunity to work together. Thanks so much.